Hey, good morning. This is Meir Valensky with Driving Markets. So, what was driving markets on Friday? What exactly happened? So, the Dow closed down slightly, very small amount. The Nasdaq closed down more than that, a few hundred points, and the S&P also closed down significantly. Interesting that the options traders were very quiet on Friday and didn't add on any particular premium to the options, whether long or whether calls or puts. So that's very interesting point to be aware of that. It's an indicator, it's an underlying indicator where they don't see much volatility in the next few days. It's good to look at the option trading section and see exactly what's going on there. Notice that US Treasury yields have gone to an all-time high the all-time high in the last 2 years, at 1.77%. Why would a yield go up on a treasury note? A treasury note is in effect a government loan. What are they doing is they're issuing notes and they're borrowing money. So the US is borrowing money in order to fund the infrastructure, where the infrastructure is to do with the buildings, the roads, the networks, the running of the country. So they issue these government bonds called US treasuries or bonds, and they could be short-term, 2 years to 5 years, they could be 10 years. The 10-year note is running at 1.77%. Why is the yield going up? Okay, it's a good question. You need to be aware of this. When there's a risk of inflation, then the value of money is eroded. Okay, so the value of money is eroded, the value of money goes down, it becomes less valuable, and therefore investors look for an investment that's going to either match, equal to, or beat inflation, and therefore maintain the value of what the assets that they are holding, whether it's cash or whether it's shares or whether it's investments. And in order for the US Treasury to compete with that erosion of inflation, then the price goes down and the yield goes up, in order to make it more attractive to investors to come along and buy the US Treasury. So the US Treasury is now running at 1.7%, which is the highest in 2 years. So where do we go from here? Probably US Treasuries will continue, the price will continue to fall, thus the yield will continue to rise, and until they become more attractive to invest in. Once you have the spectre of inflation or the spectre of rising interest rates, then the traditional individual or investor will go and put his money in a bank account or a guaranteed return on his money. Rising interest rates, remember, will always have a knock on speculative stocks, and the speculative stocks that are being knocked at the moment is the Nasdaq. The Nasdaq is 50% of it has no dividends paid out, 50% does have dividends, and it is being really hammered at the moment purely because it's where speculative money goes. And if you have rising interest rates, then you're going to get a guaranteed return if you put the money on cash in a bank account, rather than having the risk of running some investment that might return you money, might not return you money. You need to be aware of that also. That's more or less it. I'm keeping it short today because someone mentioned on Friday that it should not be more than 3 to 4 minutes, otherwise it becomes boring. That's just a quick update. What we're looking for in the next week is we're looking to see how the markets will react to those numbers that were issued on Friday regarding the non-farm payroll. I'll catch up with you tomorrow. This is Meir Valensky with Driving Markets. You can catch me on LinkedIn, WhatsApp, Instagram, Valensky Meir, YouTube, where else? That's more or less it. Have a good day. Speak to you soon.